Hello, chart watchers, and welcome to this Tuesday, June 12th, Market Watchers Live Show with your hosts, Tom Boley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market continues its rise. You can see the Dow Jones Industrial Average currently up 25 points, the S&P up 7. The Nasdaq on a relative basis performing extremely well, breaking back up above 7,700, up 45 points today. The Russell 2000 also gaining its relative strength, moving up about 10.5 points, 1685. 10-year Treasury yield just kind of meandering, 2.97%. We do have the FOMC meeting that has convened. We'll get the latest update from the Fed tomorrow afternoon at 2 p.m. Volatility index continues to drift lower, down about 2% today to close to the 12 level. Utilities bouncing, but you can see not very strong group, but we are seeing a little bit of leadership in utilities today. The other two groups, though, that are leading, consumer discretionary has been on a roll for the past couple of weeks. Certainly has been a strong month in June as retail stocks have performed exceptionally well. Technology also performing extremely well. You can see a pretty big difference in the makeup of the chart between technology, consumer discretionary, and then utilities, which has been mostly lower. Among individual stocks, the best stock in the Dow today, Caterpillar, making a run at 160. You can see the significance here. Over the past couple of months, we have not been able to get a close over 160. Caterpillar getting close, up $3 to 159 today. Salesforce.com, one of the better performers in the S&P 500. It is breaking out above the recent high. They did come out with strong earnings about 2 weeks ago here on this breakout, pullback, hold the rising 20-day moving average, and then continue higher. Finally, Tesla having a very strong day today, continuing its move off of the lows that we saw at the end of May. That was down below $280. That's a far cry from where we are now. Tesla up near the 350 level and getting closer and closer to a major price resistance level at 360. Okay, Aaron, it is Tuesday. We've got a lot going on today. Market's still trying to figure its way higher and higher each and every day. How are you?
I'm doing quite well today. I'm a little concerned. It's going to get over 90 degrees today in Southern California. So the air conditioner might be running overtime today.
Yeah, we got things been heating up here on the East Coast as well. We've got today temperatures actually are kind of mild. I think high around 80 or something. But I think the next several days back into the 90s here on the south side of Charlotte as well. So,
oh, wow.
Everything's warming up, including the stock market.
Yes. Well, it's going to be interesting to see how, the meeting between North Korea, of course, and President Trump going in. It'll be interesting to see how the market digests all this information.
Yes, so far it's been rather muted. I mean, and honestly, I wouldn't have expected the market to, to me, it's a much bigger political deal than it is market moving kind of a deal.
Mm-hmm.
If we enter into some agreement where, North Korea becomes more of the global economy, I really don't see that making a huge impact. So I think the market's kind of taking it the way I would have expected it to. Really.
Well, we'll have to see how China takes it. I guess that's one of the concerns as well. So.
Yeah, that is a bigger issue for sure.
But yes, I am ready to get started with the show. How about you?
I'm ready. Let's do it.
Okay, so here is our weekly schedule, some of the important items coming up. We have Richard Buckley on the show tomorrow. That will be really interesting. Bill Shelby from StockCharts will be coming on Thursday. And, I have a workshop next week. Grace and Rose will also be here. And, of course, Julius de Kempenaar making his monthly to semi-monthly appearance on the show. So that'll be fun as well. He'll talk all kinds of our RG. Today, we are looking at Tom Boley's presentation on PPO trading secrets. So that'll be a great presentation, I am sure, Tom. 10 and 10 to 1, we're going to look at McDonald's. They had a town hall plan this morning and organizational structure changes. So it'll be interesting to look at that chart. And then I'll be doing a question bank, basically covering some of the basic questions we get here at Market Watchers Live as far as the show and access and that sort of thing. So, okay, Tom, is technical news and headlines. What do you got for us?
All right. Well, first, not a whole lot of news out, but again, the FOMC is meeting today and tomorrow, so we'll get the latest from the Fed tomorrow at 2 p.m. Eastern. We did have May CPI out along with core CPI, and they both came in matched expectations, rising 0.2%, so 0.2%. That's exactly what the market was looking for. So really no big shakes there. Market, I think the bond market just kind of waiting to see what the Fed has to say. And I pulled up the 10-year Treasury. I would always like to start with what's going on in the Treasury market. But you can see the 10-year Treasury yield. This is a longer-term chart going back 3 years using a weekly chart. And you can see the low that was established back in the middle part of 2016. And then this pullback off of a huge rally in the second half of 2016. We pulled back, created a low at about 2.05% in September of 2017. And if we connect those two lows, you can see that intersects up close to about the 2.70% level now. And our two most recent lows were very close to that level. And we had a double top breakout at 2.6. So I think from a longer term perspective, I'm always looking at the daily chart, but I think from a longer term perspective, the key area to watch for, I think, would be this 260 to 270 area. Probably would create some short term issues if we saw the 10-year Treasury yield dropping back down to that level, because anytime the yield is dropping, that means money is rotating into Treasuries. And if money's rotating into Treasuries, that is obviously money that is not rotating into equities. So we do want to watch to see if we pull back to that level. I think we could pull into this range and still be okay. I think if we were to fall much below that 260 area, I would really become much more concerned, especially given what may or may not be going on in the equity market. In other words, if we're seeing rotation to defensive issues in the stock market, along with a move into treasury assets, then I think that combination could be a problem for the market. Now, that's looking way ahead, and I don't think that's going to materialize, but that's something I would be watching for. That would create some anxiety for me anyway, looking forward. Let's take a look at some of the things going on in the market. First, I'm going to pull up the Dow Jones because we did break out above 25,000. Recently, you can see that's been an area since mid-March that we really have struggled to get through. We did open one day just above 25,000, printed that bearish engulfing candle. We went back down for another week or so, and now we've made the move back up and we've cleared 25,000. So I think on the Dow, where I'd be watching is you've got some pretty good price support around 25,000. You've also got the rising 20-day EMA. If you look at the PPO, we'll be talking about this in just a little bit in the workshop. But the PPO, with it rising like this is telling us that price momentum is accelerating. It's the highest that this has been since back in the late January period before we saw the swoon in prices in February. So I think things look as good on the Dow as they have in at least 3 to 4 months. And so in that scenario, a pullback to test the rising 20-day moving average you would expect to hold. And that is down at about the 24,900 area. So I think 24,900 to 25,000 provides us really good short-term support on the Dow on any weakness. And of course, the timing is important because this time of the summer, mid-June, is not exactly a bullish time for equities. We are continuing to move higher. And I don't treat seasonality to the same degree as I treat technical price action. To me, that the technical price action always trumps seasonality. But I prefer when they both align and move in the same direction. And right now, seasonality is just saying, be careful. Not that we usually see huge selling. It's just that we don't normally typically see a lot of gains. The S&P 500 made its way back up above 2750. We had struggled there, 2740, 2750 for the past few months. We made it through. Now we're challenging this overhead resistance from February and March between 2775 and 2800. We're currently at 2789. This close back on March the 9th was 2786. That's the highest close that we've seen since we had all of the selling. So this is a fairly good level that the S&P 500 is at on a closing basis, but I would like to see it clear 2,800 because we did test that in mid-March on an intraday basis. Let's keep going with these major indices. Next up, Nasdaq. The Nasdaq is hitting this resistance here at 7,700. That's where we had moved up. I think we opened at 76.97, I believe. Yeah, 76.97 and change back on June 7th. Today's open is 76.73. So if we move through it intraday and then we fail to hold and come back down and close below, it could be a short-term issue. I'm still looking at the overall PPO, which just continues to rise. I think the bullish momentum is building. I think this is definitely the start or continuation, I should say, really, of the bull market that we've enjoyed since 2009. The Nasdaq breaking out to new highs with an accelerating PPO is always a good sign. Let's pull up the Russell 2000. This is an index small caps that has performed extremely well over the past few months. You can see the S&P 500 was still trying to get back through the February reaction high, which on the Russell 2000 was at about 1550, 1560. You can see we're 120 points above that on the Russell 2000. So we're seeing a lot more relative strength in small caps. This is a group that's very aggressive. So it's letting us know that traders are willing to take on that additional risk. But anytime we've got small caps moving higher and breaking out to all-time highs, it is a pretty good indication that our domestic economy is expected to strengthen. The Russell 2000 doesn't go up because things are great in Europe or in Asia. The Russell 2000 goes up because things are good here in the U.S. and the market is anticipating things to continue to improve. And so really a couple of good things come out of the Russell 2000 leading to the upside if you're invested in U.S. equities. Let's keep moving. I want to talk a little bit about the consumer discretionary group, the XLY. Mentioned it at the open of the show, but you can see just every day we are pushing higher and higher and higher. And one of the big reasons is just the retail stocks. Look at the move on the XRT. We are up about 8 or 9% now month to date on the XRT, which is a very widely diversified retail ETF. There's no one or two stocks that is driving the XRT higher. From the last time I looked at this, I think the highest percentage that any stock comprised within this ETF was like maybe 1.35 or 1.4%. So that's an indication that there's not one or two or even a handful of stocks that's leading the XRT. It's the entire group that is rolling to the upside. And when you take a look at some of the industry groups, the apparel retailers, you can see we are just exploding to the upside. Clothing and accessories, another group exploding to the upside. And I can go right down the list here, but we also have the DJUSRS, which are the specialty retailers, continuing to break out, push to new highs. We've got the DJUSCS, which is your specialized consumer services, breaking out. How about broadline retailers? DJUSRB, breaking out. And let's throw footwear in there. These are all industry groups within the consumer discretionary space, by the way, breaking out. Really hard to get bearish when you've got consumer stocks, especially the discretionary group, moving to new highs, because all of these industries represent companies that sell us things that we want, but that we don't necessarily need. So you're only going to be buying these things, and these stocks are only going to be anticipated to move higher when the economy is strengthening. People feel good about their jobs, people feel good about their income, and they're willing to spend on discretionary items. So I find this to be extremely bullish. And of course, the one thing I always look at, probably my favorite relative ratio, is the XLY versus the XLP. This is just telling you how consumer discretionary is doing relative to consumer staples. So they're both consumer stocks, consumer driven, but the discretionary is more of an aggressive part of the consumer stocks, whereas staples are more defensive. So I'm going to go ahead and change this to a line chart, and let's go back and let's take a look at this over the last 10 years. So this is throughout the bull market. But you can see after moving up, I'm happy even if it just goes sideways, because it's telling us that if the market's going higher, money's kind of going into both areas. So as long as we're not making any major relative breakdowns, I'm good. But look at what's happened here in 2018. And one of the big reasons why I just couldn't get behind us moving into a bear market when we started hitting all that volatility, because money was rotating into the more aggressive areas within consumer spending. And that to me is a bullish sign. So I thought things looked pretty good. I think things continue to look good. And with that, there are a number of upgrades and downgrades. I'm going to go ahead and turn it over to Erin and let her go over those with you.
All righty, let's go ahead. Okay, I'm going to go right over here. All right, so the first one we're going to look at is ENBL. This is an upgrade today. And, you know, we got a nice gap up with this move. I can see a very, very overbought PMO, though. Even though we've got, you know, that bottom and it's starting back up, I would be a little bit concerned about this overbought condition. But, you know, of course, off of a parabolic rally like this, you know, you'd expect to see an overbought PMO. Also, a little warning there when you see that parabolic shape. We could see more than just this correction back here. But with the upgrade, maybe we can get that breakout to the top side. But I am not expecting that just because we are seeing such overbought conditions right now for ENBL Enable. And let's look at Albemarle. This was also an upgrade today. Nice, you know, rising trend here, not too steep. I always look at where the 50 is compared to the 200-day EMA, and it is there's a lot of margin between the two, and of course the 50 is below the 200. So you always have to be careful if you see chart patterns or anything like that, and there's that negative sort of a bear market bias to the chart. You need to be aware of that because a lot of times you're not going to get the outcome to the upside that you were expecting. So I would keep that in mind. But with the upgrade, I like that we're still sitting in this rising trend. It didn't go too crazy. We're up a little over 1%. Nice PMO though, right? It's slowly turning itself around. The scooter's awfully low, but I think there's some potential here. We need to get above that 50-day EMA though. And I would like to see at least an intraday touch above that 50-day EMA by the end of the day. That would show price really breaking out of this rising trend channel in the very short term. I have 4 downgrades for you today. So let's start with C's. SeaWorld Entertainment. And again, look at these parabolic shaped rallies, and you know, we got the deep move down today, but I would be aware that we could see even more because this is now being downgraded. And again, you look at that parabolic shape, and typically when parabolics break down, they're going to go down to the last area of, you know, the consolidation zone. And I would be a little bit concerned that we could see a move all the way back down to like $15 and maybe not even get back up there for some time. So I would, if you were holding this, I would certainly be considering leaving it. I know the PMO looks good. It's been rising. It's still rising, but again, with the downgrade on a parabolic rally, danger. Let's go to BPL. Buckeye Partners. This was a downgrade today as well, but we just got a PMO buy signal on it. You know, the 50 is again well below that 200-day EMA, so we need to be a little cautious here. But I like that PMO crossover, and we didn't have to go all the way down to the deep oversold territory in order to get that signal. So watch real closely here. I don't you know, it's a downgrade, but it's already kind of sitting at its major support level here. So I think there's still some upside potential with that buy signal, and you can see the 5 just about ready to cross above that 20-day EMA. TRGP today, Targa Resources. This was also a downgrade. Find that interesting coming off of this yesterday's move that broke out above overhead resistance here from that January top. And, you know, we've got the PMO buy signal now. So, and it's not overly overbought, it's at a reading of 2. And we can see that typically the range is going to run between 4 and -4 typically. So we're not completely overbought yet. We did get that breakout. Today we're getting a pullback on the downgrade information, but we're still maintaining that rising trend channel. So, you know, see if we can get this PMO above the previous top. That would be some great confirmation that this breakout will have a continuation, and we'll see it break out again above this overhead resistance at the January top. And you can see actually it's the intraday high for that top is just above $50, and we're just above that. Not currently trading, but our intraday high was above that. So I don't think we have to worry about that too much. And then finally, ABX, Barrick Gold, was also downgraded. And I see that PMO turning up above the zero line, and that's fairly positive. And we're in a trading range of which we're a little bit more than halfway into. On the downgrade, and with what I think is not the best outlook for gold in general, while miners don't necessarily trade at the same rate, I would still not be expecting too much out of Barrick Gold at this point. I think there's other areas of the market you could get into, and that's some pretty serious overhead resistance we're looking at here. And that's all I have for upgrades and downgrades. Are you ready to kick it off with your PPO trading workshop?
I am. So today we're going to talk a little bit about the PPO and the MACD. Both of these are momentum oscillators. They're really almost identical. I'm going to explain the difference, but it's a pretty subtle difference between the two. You probably, when you look to see, when you look at them on a chart, you're probably not going to see much difference in the way that the oscillators appear. So let's take a look at first the definition. And I would suggest anytime you are looking to learn about a new indicator, start with chart school. The best, I would rather start with chart school rather than start with my portfolio balance and try to start trading off of an indicator that you don't understand very well. I think the real key, whatever indicators you use, you really should understand what makes them tick and how they're calculated and why they work, why they don't work, what their limitations are, and so forth. So I had written an article, this was probably about 3 years ago, about trading secrets, MACD trading secrets. And it was probably one of the most popular articles I wrote. So I thought it would be a good time. I know there were a couple of comments that came in talking about the MACD and the PPO and whether I could do something to talk about that. So I went back to this MACD trading secrets article that I had written a few years back. And we're just going to kind of bring them back, some of the topics that I discussed. But before I get into it, I want you to take a look at the difference between the MACD, which is the moving average convergence divergence, and the PPO. So the easiest way to explain it is to put it all on one chart. So this top panel up here you'll see is the MACD. Next up is the PPO, and then I've got a price chart. Now, normally what I have is a 20, 50-day, and sometimes a 200-day moving average, but I changed it. And if you look down below here, I've actually set up my exponential moving averages for 12 and 26 periods because that is the default that's used for calculations of both the MACD and the PPO. So when you come back up here and you look at the 12 and 26 period, of course, this is a daily chart, so it's the 12-day and the 26-day exponential moving average. The difference between these two moving averages, in this case, this is Micron technology, the difference is 2.25. The 12-day EMA for Micron is at 59.56. The 26-day EMA is at 57.31. So the 12-day is $2.25 higher than the 26-day EMA. Now, when you look at the MACD, 2.25, you see that calculation right there? It's telling you that the MACD calculation is 2.25, and I just showed you how you can put it on your chart so that you can make sure you understand where that number comes from. Also, if you look over here, you'll see that this black line, the thick black line, is also sitting at about 2.25. So this is your visualization of the difference in those two EMAs, and that is highlighted here by the number. The PPO, the only difference between the two is that the PPO, you take this $2.25 and you divide it by that 26-day EMA, which is 57.31, and you get this difference in moving averages in terms of percentages as opposed to dollars. So here you can see the PPO is 3.93. This is the math right here that you can do to come up with 3.93%. So that's the only difference. Look at the chart. Look at the MACD and how it seems to run, and look at the PPO. Essentially, they're the same. It's just one is expressed in dollars, the MACD, and the other is expressed in percentages. That's the PPO. All right, so very important, because when you look at different stocks with different price points, if you try to compare the MACD, you can't really compare MACDs, because Micron right now has a MACD of 2.25. I'm going to bring up a couple of charts. Well, first one being Sirius XM Holdings. And look on this one, your 12 period and 26 period EMAs, the difference is 16 cents. So you look at this and you say, oh, Sirius MACD is only 16 cents. But if I go back to Micron, it's $2.25. That means Micron's more, got more momentum. That would be an incorrect assumption, because you're looking at dollars. Micron's a much higher dollar price stock. So, you could have a much bigger difference in terms of dollars, but you could have a smaller PPO. In this case, Micron's PPO is 393, which is higher than Siri. We go back to Siri, and Siri's 2.31. But if I wanted to compare momentum of Sirius to the momentum of Micron, I would want to do it using the PPO, not the MACD. Because again, your MACD is going to be based on price. PPO is going to be based on percentage. It doesn't matter what the price of the stock is. And this is even further illustrated if we bring up another stock, Amazon. Because Amazon's PPO is 2.22, which is pretty close to Sirius and a little bit below Micron. But look at the MACD. MACD on Amazon's $36, because we're talking about a $1,700 stock. So again, your 12-day EMA is $36 above your 26-day EMA. But on a percentage basis, Amazon's strength, its momentum, is actually less than both Sirius and Micron Technology. So that's the thing to really understand about calculating the MACD and the PPO. MACD is based on price difference of those two EMAs, and the PPO is based on percentage difference. So about 6 months ago, I'd been threatening for years to switch from the MACD to the PPO, and I still get a question once in a while why I switched. PPO is just better. And I had acknowledged that long ago when I was using the MACD, that the PPO is just the better indicator, because you can compare multiple stocks, indices. If you want to compare momentum, the best way to do it's with the PPO, because you are looking at percentages instead of the actual dollars. All right, so that was I just wanted to make sure everybody has that base understanding of the difference between the MACD and the PPO. Now, all the other momentum oscillators, whether you're looking at the PMO or the RSI or stochastic, whatever you're looking at, all of them have different calculations. But the MACD and PPO are very, very similar. Again, just the difference between whether you're looking at the difference in price of the two EMAs or difference in terms of percentage. So let's move on. Let's take a look at some of the things to think about when you're looking at the PPO. Now that we know the PPO and the MACD are about the same, and I gave you the reason why I think the PPO is better, all the rest of these charts I show you, I'm just going to use the PPO. If you looked at the MACD, you'd probably think you were looking at the exact same indicator. They really show very, very little difference. Next up, okay, so let's take a look at the negative divergence here. First, I want you to look at the price here. Prices are rising, but if you just look at these two tops on the PPO, they're lower. So anytime you have prices moving up, what normally happens in an uptrend is as you're rising, the 12-period EMA pulls away from the 26-period EMA, and that results in a rising PPO. But when you get to a point where the rally is becoming very mature and you get a pullback and then you break to a new high, you can see a negative divergence develop. Many times you will see a negative divergence develop after a mature rally. That doesn't mean that you're going to see a huge sell-off. It doesn't mean that you're heading into a bear market because you have a negative divergence. It doesn't mean any of that. What it does mean is that your odds are beginning to increase, that you might get more of a pullback, more consolidation than what you have seen recently. So here you can see EC moving straight up, hardly any pullback. Little bit of a pullback here. We break out, and right at the top there looks like maybe a dark cloud cover candle, reversing candle, negative divergence. That's generally a sign to me you want to be careful. Here, EC pulls back. We get almost all the way back down to the 50-day. Notice the green arrows are showing we never went below the 20-day after we had set a new high. Prices move up, The PPO sets a new high. When it pulls back, I look for the 20-day to hold as support, and that's these green arrows right here. Then we break back out and eventually make another huge push up, put in the negative divergence, and then notice the 20-day doesn't hold. We go back down. We essentially hit the 50-day. The PPO moves back down to the centerline support area, and then another rally unfolds. So again, this negative divergence did not suggest that we were going into a bear market. It suggested that this major uptrend that we saw with 20-day EMA support holding simply went into a period of consolidation where the 20-day no longer did hold. And we went back to the 50, got the MACD back, PPO back to the center line, and then we started a new rally. And then eventually we put in a new high. We put in this lower price. We got a negative divergence. And once again, we go back to that 50 period. We go back to centerline support. And now we're just simply consolidating here sideways on EC. Now, I did mark here, is this a negative divergence? Look at the dotted line coming across here. We got higher prices and we've got a lower PPO. By definition, that's a negative divergence. Higher price, lower PPO. I ignore it. It's one of the secrets for me. I ignore it because this negative divergence, in my opinion, has already played out. When you go back to the center line, what that means is that your two moving averages, and again, I always use the default 12 and 26 period EMAs. When you get a zero line test, it means that your 12 and 26 day EMAs are identical. There's no momentum in the market. So you've completely unwound whatever momentum you had previously, and now you're starting a new uptrend. I personally think that this is a mistake to go back and compare where it was before. It's just the way I look at the market. Let's keep moving. Now, this is another secret that I've talked about plenty of times on the show. But in this case, this was back in early May, so a little over a month ago. Fossil Group. Notice here we broke to a new closing high. And notice that the PPO was lower. So by definition, we have a negative divergence here, right? Higher prices, lower PPO. That's a negative divergence. But I want you to notice a couple things. Number one, you had a huge spike in volume. And I've talked about this many times. If I'm getting a breakout on massive volume, it's hard for me to argue that momentum is slowing. Yes, price momentum is slowing because it's a formula. So the PPO is just simply based on a formula. But I'm not blind. I can see that we're breaking out to a new high on very heavy volume. I don't see this necessarily as slowing momentum. The other thing is, and I've said this before, when you make a breakout, how far is this rally going to go? I don't know that it's going to stop right here. I mean, we got a nice breakout on heavy volume. I'm looking for further price appreciation to the upside. And if that occurs, then we could see this PPO really start to move up and the negative divergence get eliminated. And that's why when I first see a negative divergence, I don't act. Now, if I get a negative divergence and the volume is really light, that makes me a little nervous. If I get a reversing candle and I was in shorting mode, then maybe I would short that particular security. But in this case, I'm getting a breakout with heavy volume. So what happened here after May 8th? Well, here was the negative divergence. Look what happened the next 2 days. If you had shorted just based on the MACD, or PPO, I'm sorry, in this case, or if you had shorted based on probably just about any momentum oscillator, it would have been a big mistake. And it's one of the reasons why I always talk about, for me, price and volume being my number one indicator. I'm getting a breakout here on heavy volume. I don't care what the PPO is telling me, to be honest. I've got a major breakout. Now, if I had a reversal, failed to hold the breakout level, and the volume was heavy on the reversal, and then I have a negative divergence, yeah, that could be a warning sign. But here we got a breakout. Notice what happened. Volume stayed very heavy, continued moving higher. What happened to that negative divergence? It's gone. Now, some might look at this, especially those who really don't follow technical analysis, and say, look at this. You said there was a negative divergence. It didn't work. Technical analysis doesn't work. Well, it worked perfectly here. We broke out on heavy volume. So negative divergence to me on the PPO is a secondary indicator. My primary indicator is bullish. Next up. All right, Centerline Crossovers. these can be very, very misleading. And what a centerline crossover is when you're following the PPO or the MACD or the PMO or RSI, any of these different, well, not really RSI, unless you're looking at maybe 50 as being kind of a center line. But using the PPO, MACD, and the PMO, anytime you cross from a negative reading to a positive reading, that's generally a bullish sign, because when you're in negative territory, your short-term moving average is beneath your long-term moving average. When you cross, it flips, and now your short-term moving average becomes higher than your longer-term moving average. So it's short-term momentum is beginning to strengthen in the particular stock. Now, RH, this was Restoration Hardware. This was back in 2016. But here's a stock that had been moving higher for about, 5-6 weeks. And we got this positive crossover. But to me, it was not, it was a bullish crossover. Anytime you cross over the center line, that's bullish. But was it a buy? Would I buy that crossover? And my answer is absolutely no way. First of all, there are a couple warning signs here. We broke down on massive volume back at the end of February, below prior price support around 47, 48. And notice as we came up here and we got this bullish crossover, did we ever take out price resistance? No. How about the latest breakout above this high? You can see the PPO's rising. That means momentum's building, right? Where's the volume? We're breaking out here to another high. It's a 2-month high. We got a strong PPO. Why is there no volume on the stock? Well, we're hitting a key area of price resistance. And again, to me, this can be a very misleading signal when you make a break above centerline resistance. Now, if we were getting a price breakout and at the same time the PPO is crossing, to me, that's a confirming signal to what price action's telling me. But when I get a breakout like this, a crossover that looks good, remember, this is just price action. Has nothing to do, and it's based solely on that mathematical formula. So you want to really be careful if you read too much into that. I think it can be a huge mistake. Here, we never took out price resistance. Volume did not support this move to the upside. We had a prior downtrend, and we rolled right over. And if you got in on this move here on breaking above the center line, you probably would have gotten there around 44, 45. It would have been a pretty ugly move down in the month of May. Hard to tell where you would put a stop in, but for me, that would not have been a buy signal. So just remember, PPOs, MACDs, whatever, in my view, they're secondary indicators. They can confirm great price action, but they also can give you very misleading signals from time to time. And I think this is a perfect example. All right, next up here is another bullish crossover, right? And I'm giving you this one. This is in real time. This is today's action right here on Snap. Snap looks good. Volume actually picking up, so that is maybe a little bit of a positive. But we just got this centerline crossover. But when I look at this, there's a major area of resistance. We gapped down on over 150 million shares from about 1420 back in early May. We are just now about to fill this gap. I would not be surprised if Snap were to roll over. I wouldn't short it because I don't short in a bull market, but I would not be buying it either up against major price resistance, even though the PPO is telling me that the price action is accelerating to the upside. I can still look at the chart and see that we haven't even gotten through gap resistance at this point. And that is major gap resistance based on that kind of selling. So Snap, I just wanted to point out something in real time. We'll kind of watch this one going forward. Let's see if it breaks out. And by the way, there's no guarantee we're going to roll over and go lower, but I'm playing the odds. And I think that they're way better stocks from a momentum perspective right now than Snap, even though in the short term, we did get a nice move. Once we got into this gap resistance area, we broke above the top of gap resistance. I think that did give us an opportunity, and especially getting through the 20-day. I think I remember talking about this one a couple of weeks ago, not really liking it as it was testing this area. I wanted to see it get through the 20. It did get through the 20, but now it's got its overhead gap resistance to deal with. So we'll see. Another one that I wanted to give you an example. Here's a weekly chart on Bank of New York Mellon Corp, ticker symbol BK. Look at this slight bearish PPO centerline crossover. that we came down. We went just below that center line. And you might look at that. We've been above it for a couple of years. And so if that was your primary indicator, you would have said, I'm getting out or I'm going to short it. Look what happened. Right there is where it bottomed. But if you go back and you look, that was pretty key area of price support at $50. So again, this is an indication where price momentum appears to be accelerating to the downside, but we didn't lose price support. So price support, again, is going to be my number one indicator. Acuity Brands, AYI. This is one from a line chart perspective that it's better to use a line chart. And I'm going to give you the example here. Now, this was action back in February of this year. But if you look at a candlestick chart, in order to get a positive divergence, what you need is a lower price and a higher PPO. But if you look at this chart just based on the candlestick, you really don't see a lower price. At first glance, we don't have a lower price. Well, keep this in mind. PPO and the MACD are based on closing prices, not on intraday prices. So even if we saw a long move, tail down here to the downside, that would not signify the lower price because we have to see lower closes. So here, where are our closes? If you're not familiar with candlesticks, this could be a little confusing to see whether or not we have a lower close. Well, if you use a line chart, now look at it. You definitely have lower closes and you have higher PPO. So you do have a positive divergence, and we did see at least a temporary move back to the upside before the overall downtrend continued. So if we go back to that candlestick chart, now if you know candles, you know that the bottom of a red filled candle is your close, which was at about the 145 level. And then here's the lower low close that we saw down at about 142. So if you're using a line chart, that's where we get the lower low. This hollow candle right here, you close at the upper end of a hollow candle. So the close was up closer to about 149. So that's why we see this lower close on a line chart. Again, there's your example. So if you're ever questioning on a candlestick chart whether or not you have a positive or negative divergence, I would suggest you pull up a line chart. It's much easier to see. It gets rid of all that noise, the candlesticks themselves. It gets rid of all of the intraday action, and a line chart simply connects closing prices. So the line chart is a great tool when you're trying to decide whether or not you have a positive or a negative divergence. Okay, this is a kind of something to keep in mind. When you have huge sell-offs in a stock, like Philip Morris had back in late April, you will see a huge spike, in this case to the downside in the PPO. And notice how the PPO keeps improving here. It looks like price momentum is really looking good, right? I mean, wow, this is some really nice action in the PPO. Price action kept going lower. This was not a signal that we were recovering on Philip Morris. This was a signal that this mathematical form quickly. The 26-day moving average takes longer. So as a result, the PPO took a big hit in the first week to 10 days of this move to the downside. And then by simple math, as you stay down here at this price longer and longer, that 26-day moving average starts to play catch up. And so you see a reversal in the PPO, even though price action is not reversing at all. It's one of the reasons why I don't like using the crossovers. And a lot of times I talk about a stock, if it's below the center line on the PPO, is having negative momentum. That, I think this helps to illustrate that point. When you're having a big sell-off, especially on very heavy volume and a quick move like this to the downside, it's not at all unusual to see the PPO begin to rise, even though price does nothing back to the upside. And I kind of use a rule of thumb that the PPO, if it gets to 8 or 10%, either positive or negative, that's a level that you really want to be careful of, because you almost always will see a positive or negative divergence develop after that. But I don't know that it's always telling us that we have a reversal at hand. So you want to be careful. Now, if I go back and look at Philip Morris, I'm going to stretch this out. And let's go over the last 5 years. I'm just going to leave the daily chart up. First of all, check out the PPO here at -6. And now let's go back 5 years and let's take a look at where the PPO has been. And when you look back on Philip Morris, the PPO has never been lower than, much lower than -2. On the upside, it's never been above 4. So when it got down to a -6, that is an unusual level on Philip Morris. But the volume is telling us we want to get the heck out of Dodge. I mean, the volume, we break down below key support, volume is massive. That to me is a sign of significant distribution. So you want to be careful when you see a PPO rising. It doesn't always mean that you've got good price action. So that's just another little tip that I wanted to point out in terms of the PPO. Okay, so I'm going to go ahead and wrap this up. Let's go ahead and bring up the summary slide just to give you an idea of some of the things we went over. There's a lot more I could cover with the MACD and PPO. I mean, literally, I could probably do an all-day webinar talking about it and how to trade it with moving averages and so forth. But hopefully this will give you a little bit better idea of what the MACD and the PPO are and how you can use it, some of the limitations of both of these, and how you can use the PPO to compare between key stocks, indices, and even using the PPO on, Philip Morris, the PM that I just showed you. Being able to use the PPO, you could go back and look in prior times to see, okay, it's never been 6% below the zero line. That is very important. You can't do that with the MACD because the MACD is based on the price difference. So depending on what price action is done over the last 5 years, the MACD could go a lot higher or a lot lower because price action has gone a lot higher or a lot lower because it's difference in price. So anyhow, hopefully you enjoyed that. There you can see the different areas of the PPO and the MACD that we covered. And I think before we move on to the 10 and 10, why don't we bring up that poll? We were asking everyone which of the momentum oscillators or indicators that you prefer. And pretty interesting stuff here. You got the MACD still the high at 27%. I'll admit, I was in that MACD camp and I loved the MACD. But I finally just said, you know what? The PPO is better. It's the same as the MACD. It's just better. It's just the new and improved model as far as I'm concerned than the MACD. But we do see the MACD 27%, PMO and RSI both 24%, PPO 18%. So a pretty tight race there.
Yeah, I'm glad to see the PMO is rating. That's very good because I do think it's better than the MACD and it's comparable to the PPO. It's just slightly different calculation. So very interesting. Somebody did ask, why is it a 12 and 26 day EMA when there's 5 trading days in the week? And my answer, of course, was you'd have to ask Gerald Appel, who developed the MACD, why he chose those. But and then the PPO, of course, uses it just to reflect the same information as the MACD. Yeah,
and for me, it's about what other traders going to do for technical analysis purposes. I mean, I'm trying to predict what price action is, what's going to happen. And almost every indicator I use default settings. So I'm going to use the 12 and 26 day EMA. I mean, you might be able to say, well, I've got one. I got the 5 and the 17 that works perfect. Or I've got the 14 and the 22 that has worked really good for me in my trading. I don't understand the logic because if you're trying to predict what other traders are going to do and they're not using that same indicator, I'm not sure how it works.
Mm-hmm.
That's why I like to go with the default. And I do that whether I'm using the RSI, stochastic, PPO, MACD, or whatever, because I want to try to figure out ahead of time as we're getting close to key levels what other traders are going to do. And if I'm using indicators that they're not using, it's really hard to predict.
Yes.
Using those indicators. So.
Well, and yeah, the PMOs are different, and I'm always asked about, why we choose to use what we do, and whether that people should use that. And I always recommend the default, just because again we developed it in such a way that those moving averages we think work better. So, recommend you read about all of them really in chart school. But wow, pretty much the 3 are a quarter. MACD PMO, a 1/4% or a quarter of the audience. I think that's interesting.
It is definitely interesting. And what's really interesting is I look at the MACD, PMO, and PPO very similar. RSI is a completely different animal. And RSI is 1/4 of the respondents are saying that RSI is their primary momentum indicator. I find that to be very interesting. And maybe we should do a workshop going forward on the RSI.
Yeah, actually, I think that would be very good. Or, I could actually come up with maybe a comparison between all of them and, give an opinion that way. So interesting. All right. Well, thanks for that. And now I guess it's time to get in that 10 and 10. I've been collecting all of everybody's requests. So let's get to it. We have so far, I had to close it up, guys. I think there were a few more that came in, but we have almost 40 symbols today to look at. So that should keep you very busy. And I'm going to look at this quickly on an RRG, and Tom can get a couple drinks of water. All right, so let's fit this in here. Obviously a big mess. We've got 39 stocks in here, so that makes it rather difficult. But like I said, I like to look at where we are as far as, leading, lagging, weak. I think it's really helpful just to see where they fit in these categories. And then I do like to look at the ones that are moving in a northeast direction. For example, Cody is moving in a northeast direction, moving into improving. So that might give us some information that it's, getting ready to get there and move into that leading category. Maybe we can catch some of that momentum before it actually gets into that leading category. As you can see, a lot of them just continue off when they hit in the leading category, but I'd like to get on board when it's, in improving and getting ready to go to leading. And I know Julius also likes to see, like with Tandem here, to see that turn in weakening to head directly back into leading. So I'll be looking at that. I like to also pick from different sectors. I look at the charts and decide if something looks interesting to me. And then everybody go ahead and vote in the chat room, like other people's symbol requests, because the most popular will be the second symbol that Tom is going to look at. And FYI, right now, Cisco is leading. So if you want something other than Cisco, get in there and start voting. And Tom, let's go ahead and get started with McDonald's, who I guess are getting ready to go through some reorganization, possibly some layoffs, but they're putting a pretty face on it. So.
Yeah, well, anytime you lay off employees, it's not good to the employees, but it's good for corporate bottom lines. And so that's what the market was reacting to, I think. The announcement came out, I think 3 or 4 days ago, that they were going to do layoffs. I don't think at that point they announced how many, and I'm not sure they've come out with that yet or not. If they have, I haven't seen it. But here was the breakout above pretty important resistance level at about 166. I noticed here the volume, so I just marked with the blue arrow there the spike in volume on that move through prior resistance. We got up to 172 the next day, and this is a lesson in not chasing, because here we are 2 days later, and we're back down to the area of the breakout. Now, I marked two levels of support. I think you got price support at 166, and I think with the strengthening PPO, now I'm going to be watching the rising 20-day moving average, which is currently down at 163. So I think 166 down to 163 is great support on McDonald's. I expect it to make another run for 176, but let's get through this period of consolidation first.
Okay. And the most popular in the chat room, Cisco did end up winning. CSCO, of course.
All right, Cisco is just kind of trapped here short term. I'm going to maybe pull up a longer term. Let's do a weekly chart and see what Cisco looks like. Yeah, part of this could be this negative divergence that developed on the weekly chart on Cisco. So we just talked about divergences and how that can create some issues. And here is your higher price and lower PPO on a weekly basis. We failed to hold the breakout level with that reversing candle. Look at the volume coming in. I think that we're just going to consolidate for a bit here on Cisco. So I think 46 is the high I would watch, and maybe the recent low. I don't know if it'll be maybe 40.5 or maybe down to 39. I'll put both of them in here because what I'm anticipating at some point, based on this negative divergence, is perhaps a 50 period test and perhaps a center line test. So when you get these negative divergence, I know you don't, want to see it go back, but check out the last one. See the higher prices here in May, lower PPO. What do? Went right back to the 50, went right back to the center line, and then we started up again. So I just think we got to work through this period of consolidation. I like Cisco. I just think in the near term, probably better opportunities.
Okay. The next one I'm going to give you is CAR.
K-A-R-C.
C-A-R. Avis.
Okay.
Sorry about that.
That's all right. Okay, CAR. Well, we're getting some strength back up through the 20. Today's going to be a pretty big day because it has struggled at the 20-day moving average. And if we pull up the little red arrow here, you can check out these tests right here of the 20. When I've got the PPO falling and I get that move back up, notice the light volume, especially this first day, light volume coming up, testing the 20-day with a weak PPO. I'm expecting it to move lower. Now, we are in what I believe is a bullish period. So I'm not surprised that we are holding on to what I think is pretty good support down at about 37 3/4. We went down, we tested, starting to turn back up again. From a longer term perspective, this is your trading range. From a short term perspective, I want to see it get through the 20-day moving average. It seems to be doing that today. If we were to fail and leave this long tail up above the 20-day and close back below it, that would not be a good sign. But I do think we're going to hold it. And my guess is we're probably going to make the next run up to about the 45 level.
Okay. Next one, we will look at Coty, C-O-T-Y.
All right, Coty. Well, here we do have a positive divergence that is building, but it is at -6%. We talked about this big move to the downside. Volume is tailing off a little bit as we're making this move. So what I would do is if I was in it, I would keep a fairly tight stop below that 20-day moving average. As long as I can continue to rise and hold the 20-day moving average, then I'm going to treat this as though we are in this uptrend. But if we start to roll back over, I'd want to keep a tight stop because this is a stock that has been in a downtrend for the last 4 months, and the volume has not been light. This has been a big volume move to the downside. So watch the 20-day on any pullback.
Okay. How about Yum Brands?
Right, Yum.
Mm-hmm. Yum.
Okay, well, clearly we're trying to get through about 84.5. We've gotten back up there a couple of times, haven't been able to manage it. But there is the prior low. We were moving up, pulled back, moved up to a higher high, had a negative divergence actually on that high and a reversing candle, shooting star. We came back down on big volume, and since breaking below this support level, notice where we're failing. We got to get back through $85. If we can get through 85 along with getting a PPO Centerline crossover, and especially if the volume comes in on that move, I'd feel better about it, but I'd probably watch it until I see it.
All right. Let's look at Host Hotels and Resorts. This is the hotel and lodging REITs industry, HST.
Yeah, the group has been pretty strong. I like this 20-day test, actually. And I'm going to pull this one up on a relative chart so we can take a look at what's going on here relative to its peers, because there's your hotels and lodging. The group is broken out. The stock is broken out. And so let's annotate this. But there was your breakout at just a little bit above $21, $21.10. Today's low got as low as $21.42, and it hit the 20-day moving average. So I think you've got two areas of support. The first being this 20-day moving average, and then the second would be your price support. I think accumulating in this area, it's down probably about 4% from the recent high. I think accumulating in this particular area is probably would be a good thing technically. I think if we closed back below 21, I'd be careful. I think we could go back down to maybe 20.25 to test this prior low in the 50-day moving average, but I don't think we're going back down there. I think I think we'll bounce somewhere between current price and that 21.10 level.
All right. Exploration and production industry, Chesapeake Energy, CHK, was very popular.
Well, the stock has just been on fire of late. I'm going to go and get away from the relative chart. I want to see if this is a negative divergence here. Yeah, it is a negative divergence, and we are potentially putting in a reversing candle. I'd be careful on this one today. Now, if we strengthen into the close, we got a completely different ball game. But if I'm looking at this, and technically I should be literally drawing it from the close, which are these closes down here, but up to here. But anyway, we do have a lower PPO with higher prices and possibly a reversing candle going in. And the key support level, we had resistance right at 480, and we broke above it yesterday on decent volume. If we come back down, we fail to hold 480. I think we could maybe fall back perhaps to test this 420 level where we've been a couple of times. Not out of the question to get a 50-day test, although I would expect maybe sideways consolidation to allow the 50-day to come up. But this is I'm going to say a little dangerous area for Chesapeake right now.
All right. Financial here. Cardtronics, CATM.
Yeah, I think this one is on my strong earnings chart list.
Yeah, it's interesting support right now.
Yeah, big gap support and price support. I think 25 to 26 is your key area here. So I actually like it here. I think that the number one, the selling that we've seen here has been on lesser volume. You can see the gap up with earnings, much bigger volume on the way up. I think it's probably looking for a turn. Now, if it goes much below 25, I don't see support really until we get down to 21. So I want this 25, 26 area to hold. We did put in a higher high today from yesterday, and this could be the start of a move back to the upside. So I'm somewhat bullish, optimistic here with CATM.
All right. Let's see. Fitbit, FIT. Mine thinks I'm dead.
Hasn't had any response lately?
Yeah, it doesn't get a whole lot of work.
All right, let's see. Well, huge move, great volume. I mean, I love what's going on here, but I just don't chase. So, I guess some looking to buy would be frustrated. I don't really get frustrated. I just look for other trades. But huge move up, very volume. We have seen some pullbacks, but we haven't gotten a 20-day test. I think there are two levels, and I don't know that we'll go all the way back down to test this area, but it looks to me like we put in a bottoming head and shoulder, left shoulder, neckline, head, neckline, right shoulder, and breakout, and look at the volume coming in to confirm this. I think this is a bottoming pattern that makes the stock buyable on a pullback. It is up at 775. Just a move back down to the 20-day moving average would represent probably about a 25% decline in the stock. I can't accept that kind of risk. So I love this. I love the action here. I'd have it on a watch list, but I don't think I could do anything until we got maybe a pullback down closer to the rising 20-day moving average, or at a minimum, maybe the latest breakout, which was right here where we moved up, went down a little bit for a day, and then broke out again. So I'm going to say 650 down to the 20-day moving average is where I'd consider building a position.
All right. And if you were holding it, after that kind of a run up, would you sell half your position? Would you just sell it now? I mean, personally, when I get a giant gain, I like to just book it and then go on to the next.
Yeah, this is a tough call because I think this is a major breakout off of a long-term downtrend. You can see gap resistance that we've really struggled. We're breaking through. This looks like a pretty big change in character for the stock longer term. So for those that are willing to hold, I think it probably is worthwhile to do so, although you got to be willing to watch a pullback, maybe back to that 6.5 level, and be okay with that. I would prefer seeing the pullback and then getting in because I can keep my stop a little bit tighter. But if I was already in it, I think I'd probably let it run. Being the longer term, looking at it from a longer term perspective, I think it looks pretty good here on this weekly chart.
All right. And one more for you. How about General Motors? Big gap up earlier at the end of May.
Yeah, I like General Motors. I like the autos. I think Tesla looks good. General Motors probably looks best of all. I love that gap up. This was when they came out. I think it was SoftBank announced that they were going to put $1.5 billion. I'm not sure I got the amount right, but I think it was $1.5 billion into GM's driverless car initiative. And not only did we get the gap up, but you can see we have continued pushing higher with very strong volume on most of this move to the upside. So I think you got great gap support and the 20-day moving average back in the low 41s. I don't know that we pull back there, but I think somewhere in the middle, maybe we pull back, the 20-day rises, and I would use a 20-day test down the road as a possible entry point into GM. I like it.
Okay. And that concludes our 10 and 10. And you did pretty good. Even I know your voice has to be a little bit raw there, but took care of it. And we will have these charts up in the Market Watchers Live chart list, and I will get those up as soon as possible. And there you'll get them along with their annotations and the chart style setup that Tom has done. Okay, I would like to steal that screen, and I am going to talk to you about ChartCon. StockCharts.com/ChartCon, and that'll bring you right to this lovely page that will tell you everything about our upcoming conference. It is a streaming conference, so you do not have to get on an airplane, book a hotel, or anything like that. You'll be basically sitting in the room with us via the television camera. So you can also contribute in the social networking. We will have ways for you to do that. Amazing agenda, amazing speakers. We also have a little commercial here if you want to check that out as well. Gives you some information. And to register, of course, click the big green button. And cost is $249, which is really, as I keep saying, quite the bargain considering the knowledge you will gain. And you do get to keep all of those recordings so that you can go back and look at them. And I suspect just from perhaps Martin Pring, I will make up this money in a trade somewhere. So I think that you might want to consider that a great investment, maybe even tax deductible for some people. I don't know. Go ahead, stockcharts.com/ChartCon, and come check it out. Okay, time for our final market update. Wanted to take a peek at our predefined alerts, which are going quite crazy right now. Russell 2000 has now set a new all-time high, as has the Nasdaq. So we're looking at some pretty strong bullish wins right now for the Nasdaq, and of course those small caps making big moves today. Let's go ahead and look at the candle glance. I'm going to set that up for us right here. You can just click and you're going to get all of the major markets, advanced decline information. So as you can see, it was really kind of a choppy morning for the Dow, negative territory, and choppy trading for the S&P, only in positive territory. Both pulled back quite a bit here. The Dow is up only slightly right now. S&P 500 up 5.78 points, and Nasdaq, there you go, nice rising trend pretty much the whole day. Did not really experience too much turbulence on the early part of the day. Russell 2000 also looking very nice with that rising trend, pulling back just slightly off of the intraday high and all-time high, as we just found out. Wilshire 5000, very similar trading, but we are looking at, again, a rising trend channel, and it is holding up so far. Treasury yields, 10-year Treasury is up slightly, reading 2.96%. UUP has just been all over the place today. Currently near the intraday high, up 2 cents at 24.68 for UUP. Commodities started lower on the day, but now are making a comeback, reading at 17.88 for DBC. And USO, nice little rise in the morning, and now we're just moving mostly sideways, consolidating that 8-cent rise that we have right now. GLD really taking a bath today. It gapped down, made that attempt to get back up while you can see the dollar was moving down. That coincided and didn't help, and now it's just heading lower. Currently, GLD reading at 122.84. The VIX is moving lower. People are getting, investors are still fairly comfortable with what's happening in the market, and I don't blame them. We've had a nice rising trend beginning this nice rally. Advances declines are really mostly unchanged from yesterday, so not reading much there. And I'm going to conclude our final market update and move into our final segment, which I'm going to anchor today. And I called it Question Bank, mainly because I wanted to cover, we get all of your survey responses and we absolutely love getting them. They are very helpful. They help us to mold the show into being what it needs to be. But we also get your questions about, some of the basics, where you can find things. And I want to just sort of go through all of these Market Watchers Live show tips. So I'm going to go ahead and start with, everybody, we get this question probably every other day about how you can find the StockCharts TV or Market Watchers Live replays. So I wanted to show you all the different ways you can get to our Market Watchers Live show. And of course, it would start with our webinar tab right here. This isn't going to play. I just want to give you an idea of where we're at. And you can see on the right-hand side is where you're going to get your question box lighting up. A lot of people have asked, well, where is this chat room? Well, it is only available if you watch the show live from the StockCharts TV tab on our website. So right there, StockCharts TV tab. And I'm going to just take this real quick and say the PMO, because of course that's the one. And so that's where your polls are. And then the questions, of course, over here. And, that's where I'm taking your symbol requests, etc. So you can ask your questions as well during the show. Maybe we can, if we can't get to it, if it's more complicated, we do get a copy of all your questions and we will try to get those answers to you as soon as possible. So the schedule is down here and we are live right now, obviously, and we replay Market Watchers Live quite a bit and you can see where that shows up. Later in the day, though, we will have links to the StockCharts TV or the StockCharts YouTube channel. And so these replays that are showing here, a lot of times are going to turn into a button that'll take you directly to the YouTube version. And with that, let's look at the YouTube page for StockCharts. And let's see, we want to go to YouTube. I'm going to just start from the beginning so that you can find these things easier. So we'll just go to our youtube.com. Go ahead and in the search box, type StockCharts. And you will now get to our StockCharts YouTube channel. You can subscribe to it as it shows there. But not only on this channel can you get the videos.
You've got a problem.
Hang on.
There
we go. Not only can you get the videos for Market Watchers Live, but you can also get them for our other shows here. And I know that if you do some searches, you can get to some of our special guest appearances videos, so you'll find those there. There's chart school videos. The StockCharts YouTube channel is chock full of videos and information. So that's where you can go also to get to the Market Watchers Live replays. And that brings me to the Market Watchers Live blog. And we're going to go right back to our regularly scheduled program here at StockCharts.com. And I don't want that one. All right. So now you've gotten to the YouTube channel. You're ready to watch the Market Watchers Live show. You've finished work or lunch. You finally get to do that. At the end of the day, Eastern time, I'd say probably after work at about 6 p.m., 7 p.m. or so, I will write the Market Watchers Live blog or the Market Watchers Live recap for the day. So you go to our blogs tab, go to the StockCharts blogs here, of course, click on Market Watchers Live. Now what you'll notice right off are, of course, the listings of those posts and all of those recaps, but this is where you can also get to that Market Watchers Live chart list that I always talk about when Tom finishes the 10 and 10, and you get to see all those symbols. That's where you're going to find those. And here you go. From June 6th, it'll start the last 3 shows worth of 10 and 10 symbols. And as you can see, you've got all of the annotations. You also get the different chart styles. So for example, if, Tom uses a relative chart, that's you know, what you'll see here. And the beautiful thing is if you click on these and you like this chart style, you can save it. So for example, if you like Tom's, let's see if we have a relative chart in here, because that's the other one. All right, I don't see one right away, so I'm not going to worry about that. But if you see his relative chart, that's the other way you can get to it and save it as a chart style for yourself. So let's go ahead and we're going to look at one of our blog entries here. And I'll start here so you can find where you can go to get it. All right. And so let's go ahead and we'll look at one of the recent ones so I can show you how you can use these, especially if you're watching our reruns on YouTube. And again, if you go back to say June, 6th or 4th, the recaps are still here. And once you have the recap, that'll give you a way to focus in on the stuff you really wanted to focus in on. I mean, I recognize the fact that maybe you don't want the news of the day if you're coming back to watch this 5 days later. So what we do is, here's your weekly schedule, and a lot of people ask us, where's the weekly schedule? How do I know when people are coming in? Market Watchers Live recap, first thing. What our weekly schedule is, just from the show. I just screenshot most of these. You'll get the agenda for the day, but this is the important part. So you'll get, for example, here are our Monday setups, and this gives you the timestamp of where to go in order to just get to the beginning of Monday setups. And of course, then I give you the summary slides so you have an idea of what we discussed, which symbols. We don't go into detail here because really you need to watch the show. I can't really reprise all of the commentary and analysis that we do in a blog article and still be able to do my day, the rest of things that I need to do. So here's your, again, the earnings spotlight. But one of the things about every Market Watchers Live recap is that at the bottom, I have helpful Market Watchers Live links. And again, this probably answers a lot of the questions that we get in our surveys. And this is, how do I find Aaron's PMO scan? How do I get to Tom's blog? What is the PMO? And I want to know how it's different from the MACD. There's your chart school article. So all of this information, and there's also that the chart that Tom likes to show with the relative chart with the consumer discretionary versus staples. This is a chart I know Tom looks at quite a bit. And so there's a link right to that chart, and you can save it if you want to your own chart list. And you can also save that style. So for example, my PMO scan article, here you go. And what I would say as far as this scan, again, I get a lot of questions about my scans, is that, this is a really good kind of starting point. And I don't use it exactly like this every day. I will sometimes adjust what I'm looking at. Maybe I only want to look at the S&P 600, or maybe I don't mind if the scooter is not in the hot zone and I can, comment that out. But here you go. This is the basic one, and you can simply copy all of this, the words and writings here. So you just copy that. And then if you go to your charting, your scanning workbench, let's say new scan, and I just go in here and I paste that all in. Check the syntax, and yep, it's correct. So now you have that PMO scan ready to go. And again, you can now modify it. You can comment out, for example, I'm commenting out the scooter by adding those double I can't think of the hash marks there. So I added those, and that comments it out. Some days you just can't come up with that word you really wanted to know. So that's one way to get to my scan. And then I wanted to also show you, again, a lot of questions on getting that Tom's relative chart. So I have put a sample of one of Tom's price relative charts in here. And this one happens to be XBO Logistics, but it sets up all of the relative settings. And again, with all of the commentators, if you click on one of their charts, here's how you can see exactly how it was set up. Or you can take the shortcut like we're seeing here. And if I want Tom's relative as one of my chart styles, I'll just say under chart styles, add new. And I'll just call it new chart style. And now anytime I go to, so let's see, let's look at GE. Poor GE. And now I want it to look like a price relative chart. So now I can go into my chart styles. And I save new chart style. There it is. And boom, there you go. Now I have this in that relative setting. So I have now saved that chart style. I can now use it anytime I want for any symbol that I want. You can do this for any of the other charts you see in any of our blogs that do have a link. For example, you know, one of John Murphy's articles, if you want to copy that chart or if you like what he's done, you just click on it in their blog articles. And we'll just take one right here. So I want this transport one that he has. So I just click on it. I'm getting that version. I can now save it to one of my own chart lists if I want. And again, I can copy that chart style by adding a new chart style that way. So there's so much you can do without having to actually do the work. And so I wanted to show that to you as far as the Market Watchers live blog, how to, you know, figure out the different chart styles, how to get to the PMO scan. The other things I wanted to discuss was finding the upgrades, downgrades, and the economic calendar that Tom uses. And we get this question often, where do I find those? In fact, I think we actually got the question today, where do I find upgrades and downgrades? And actually, I think I'm going to add this into that helpful hints at the bottom, those helpful links at the bottom of our recaps. I'm actually going to make a note to do that so you can just get to it by using one of the links from a Market Watchers live blog. But if you're not going to go there and do that, for upgrades and downgrades, Tom uses briefing.com. And you can get to them. Here's the main page. And just if you go to calendars, there's the upgrades and downgrades. And then this will give you those listings, and you can get full listings of what's going on. You can see why, who did it, you know, who gave those upgrades, downgrades, et cetera, et cetera. So this is where he gets those. And then the other one is the economic calendar. So we'll just open a new tab here. And that is at Bloomberg. And see, it's trying to take me to that calendar because I use it. So if you come here, again, I'll put those links in for you. But if you come here to the Bloomberg and go to menu, oh, right there on markets, and you go over and there it is, the economic calendar. And this one's really good. I have to say, I really like this because not only does it give you, you know, what is happening, what's going to happen, but they also offer links. And when you go to the link, it gives you all of the data. It tells you what the outlook was, what was expected, and then it also gives you a definition. This is why we look at it. So I think this is an excellent learning and teaching tool, as well as just getting those that bit of information that you might need in the mornings if you can't get to Market Watchers Live and hear what Tom has to say about the economic calendar. All right, so I think there was only one other thing I'm going to cover, and then Tom, you can feel free to jump in and let us know if there are any anything that I left out or that you don't want to see. But I wanted to go to show you how to get to the StockCharts bookstore, because we also get a lot of questions. What books do you recommend? Let's go back this way. What books do you recommend? And you're going to find pretty much all you need to know here in the StockCharts store. All right. So there's must reads. You can just click in here, and these give you kind of those books that we all have used a lot. I've read many of these, working on Greg Schnell's StockCharts for Dummies, but I am using it more of a reference tool at this point. I would like to tell you that as far as the resources that I would recommend, the books I would recommend, and I think if you've watched the show enough and watched my workshops enough, you know that what I really like to use is Dr. Elder's books. So let's go ahead and we'll just look up Dr. Elder. And there he is. He will be a ChartCon, so there you are. Come Into My Trading Room is an excellent book. I use the New Trading for a Living as that's really the tool I use for most of the information if I want to go back and learn more about some of the indicators and some of the tools. This book, I think almost all of it has been added into the CMT curriculum. The Charter Market Technicians Association, they think that it's important enough to add it into all of their compilation books for the CMT exams. So I highly recommend Dr. Elder's books, The New Trading for a Living, especially because that's the one I use often. If you're a newer trader or more of a beginning trader, the Come Into My Trading Room is a really, I think that's a great book as well. And the nice thing about that is it comes with a study guide. So it helps you take notes and learn more about what you read. So that's all I had for the question bank. And please feel free to put your questions in the survey all the time in the question box. We like to see those. And I'm going to close off this particular segment. I did not have a summary slide, so we just answered all those main questions. And I'm going to bring Tom, I'm going to bring you back in. We got to close this show.
Yeah, we got about a minute or so. I was just looking at the overall market. And, of course, still having a pretty good day. The Dow and the S&P are lagging a bit. But some of the stocks on the Nasdaq doing really well. Twitter, I saw, just continues to just fly to the upside. This is a stock that opened up June at about $34, $35 a share. And Twitter now is at 44. It's up another 6% today. So really just huge action to the upside and some of the big names on the technology side. And, you know, we were talking about Twitter moving up into the high scooter ranks a long time ago. And this is what can happen when you get a stock that is hot. Money continues to rotate into it.
Absolutely.
All right. Well, here is your weekly schedule as we
go. Richard Buckley will be in tomorrow, so that will be nice. Bill Shelby's going to do his trading style on June 14th for us. That would be this coming Thursday. I have a workshop coming up on Tuesday, and having had this discussion about the PPO and questions coming in about the differences, I'm thinking I'm going to do the momentum indicators. So I think I'll look at the common momentum indicators, and we can make a comparison between, you know, how they're calculated, what we're looking at, and why we might want to look at it. All right. And then we got Grayson and Julius.
Yep. And make sure you get your votes in for Aaron's workshop. Fill out the survey. Want to thank everybody for being with us today. Please remember to complete that survey as you exit. We do like to get your feedback on what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.